I'm about to increase your passive income from your DeFi portfolio by 42% in a very short period of time, so make sure to stay tuned. We're going to get straight to it, guys. The simplest way to increase your passive income is to stay in range. Now, obviously, it's a little bit harder to stay in range. We're going to be covering that in today's video. But from what I've found after working with over 200 plus individuals in my DeFi legacy program is that most DeFi investors are out of range about 30% of the time, meaning that if they have a position and they are in range for 70% of the time, they're leaving a significant amount of money on the table. I want to go ahead and show you what that looks like. If you're in range 70% of the time and you want to be in range 100% of the time, or you do get in range 100% of the time, that is a 42.86% increase in time in range, basically, which means if you're doing a 100% APR after you factor in the time that you're out of range, your new APR is 142.86%. If you're doing 150% APR right now, you're nearing 200. Hey, if you're doing 50% right now, you're nearing 90 to 100%. This is a very, very simple and quick trick that is going to make you a lot of money. And the framework that we're going to be using in today's video is actually pulled straight from our DeFi formula curriculum, which is part of our legacy program. Our legacy program is where we work one-on-one with individuals to help them build out these passive income streams, help them optimize them once they're built, and then help them scale them once they've been optimized. And if you want to learn more information about that, there is a link right below this video. But with that being said, not required whatsoever. Let's dive into this framework. There is, in all honesty, a science to staying in range and a science to selecting your ranges for your liquidity positions. And I've mastered that science over the past 4 years that I've been investing into DeFi. So with that being said, if we have an Ethereum to USDC liquidity pool, say we're deploying 10,000 bucks in this for simplicity purposes, you can clearly see that this is going to stay in range if we just adjust our range something like this, right? But that's hindsight and knowing the previous data. If we invest in this, we could easily see a trend change in Ethereum to the point where we do go out of range. So it's all about knowing those before you actually invest into them. So when I'm structuring this range, I'm looking at 30-day highs and 30-day lows because my time span for being in a position is about 2 weeks. So I double 2 weeks, I get 4 weeks, which is about a month. So I use a 30-day calculation range. I'm looking at 30 days of data. Now, very clearly, we can see that this range is just not that good of a range. The reason why, we're super close to our bottom price, we're super far from our top price, and we're close to going out of range, right? If we're expecting Ethereum to just bounce up from here and we're like completely certain that Ethereum's not going to see another retracement, then maybe this is a good range to have 75% ETH. But in this instance, it's not, right? Because there is going to be more consolidation for ETH most likely. Could even go down a little bit more. And I don't want to put myself at that much risk. So what do? I start to adjust the max price because that's the main issue here. The max price is just so far away. I'm going to adjust it to something like right over here. This is a pretty key level because you could see we were bouncing at this level over here back in late January. And also, we started to decline at about this level as well for Ethereum. So I'll keep that at about 31.30. And that's a little bit better. We still got 69% Ethereum and 31% USDC. But I still need to adjust some things. I'm going to go over to my min price and I'm going to start to adjust this until I get to an area that I'm comfortable. Now, when I'm adjusting this, I don't really have any key levels to rely on because we're just kind of going off into thin air on this point. So we're adding a buffer room between this previous key level over here if we were to bounce down and break that key level. Basically, if we were to see a huge jump down right now, are we going to break this level? Are we going to consolidate this level? What's going to happen? Either or, we're going to be at this level, so I need to add a little bit more room. So if I go down to 2386, it's a little bit better, gives me a little bit buffer room. And I also want to pay attention to my asset ratios. And it depends if I'm bullish or bearish on Ethereum or if I'm just relatively neutral on the market. Right now, I think Ethereum's going to continue to consolidate. So what am I going to do? I'm going to adjust my max price until I get towards 50-50. Now I want to make sure that I'm finding a balance between adjusting my max price, my min price, and of course my APR. The reason why is because if I adjust it too far out, well then guess what? My range is too big. I'm not going to earn that much money. Whereas if I adjust it to something that is reasonable, it keeps me in range, but ultimately maximizes my efficiency while I'm in range, that's the ideal scenario. So if we just go ahead and adjust that min price till we get over here, that gives us about 53% ETH and about 47% USDC. That's a 91% APR, right? We need to adjust accordingly and start to squeeze it in, right? And start to capture the recent trend and trim the fat, basically. Now that we've determined that we want 52% and 47% when it comes to our ratios, we'll look at our geometric mean. Our geometric mean is the middle ground of our range, basically, which is 2671. We want to keep that same geometric mean as we go in with a tighter range. So if I go, let's just say plus 1% and then minus 1%, you'll see that that's very, very close. Our ratio is also very, very similar still. So we're just tightening up that range. And eventually you'll notice that we still have buffer room, but that buffer room is getting smaller and smaller and smaller. And that's ultimately where I would adjust my max price just a little bit more. And I would keep my 53%, 46% ratio. It's relatively similar to my original geometric mean, but I have a 125% APR. And just like that, we've trimmed the fat. We have room for volatility in case the price starts to jump a little bit, dump a little bit, right? But we're capturing the recent trend, and it looks like we're going to continue to capture the recent trend. So obviously at that point, we would backtest APR, make sure that 125% is accurate. I'm going to make it easy for you if I just adjust this to 7 days. Realistically, we're probably going to do about 120% APR on this pool. Now I want to show you a good example of staying in range in the type of returns you can get. This position right here, a 146% APR. It had a $6,000 profit, 3.2K in asset appreciation, and a $2,300 profit compared to holding the market when there was $2,800 in earnings. That means that the majority of the income generated from this position, pure profit basically, on top of holding the market essentially. And also there was asset gain, so that just makes it a beauty. Now if we look at my range over here, you'll notice that it was maximized to its fullest extent. At the beginning, yes, there was a little bit of fat over here that could have been trimmed, but then ultimately, Aether started to perform. We started to go down and down and down. It maximized the efficiency. And as soon as we go to a period where we're within, without of the range, basically, we exit and we rebalance, basically. That's a 97.5% in range rate, meaning that I maximize my APR. If I was only in range 70% of the time, I would have got 70% of 146%, which would have been a total of, drumroll please, 102%. I would have left so much money on the table. Now, I believe in transparency. The position that I rebalanced right after that one saw a big retracement with the asset depreciation. So it was down 6.8K from the assets depreciating. But with that being said, I earned $28.67 in earnings, which put me at a $1,900 profit compared to holding the market, a 121% APR in this position right here. Now, if we look over here at the divergence loss, once again, not a huge amount, still profiting at roughly 75% divergence loss profit margin. But if we look over here at the in range rate, 95% on this position, and we maximize the efficiency of the range because we started off over here, we went down over here, we went up over here, we went down over here, we went up over here, and we perfectly idled within range until we started to go out of range. And as soon as we go out of range, we get to a good period where it's fine to rebalance. We rebalance. We waited our 24 to 48 hours to see if retracements happened, and then we locked in our rebalance. Simple as that, guys. Staying in range, increase your income by 42% on average. I've even seen people that are out of range 50% of the time, 60% of the time, and it's like if you could just stay in range, right? Whether you have to go a little bit more active, perfect your rebalancing skills, stuff like that, you can make more money. So guys, if you enjoyed today's video, make sure to drop a like and subscribe, notifications turned on. And remember, if you guys want some support staying in range and implementing a framework just like this one into your portfolio, you know where to find the link. It's right below this video. See you guys later. Peace.